David Bahnsen joins us right now, Chief Investment Officer at the Bahnsen Group, counting us down to those closing bells. And David, I do want to ask you about those Fed expectations because it's a little bit of weird here. We have an inflation report that I guess removes, at least for now, the possibility that the Fed would certainly hike rates to fight inflation. But the idea is that, well, maybe trade policies and some other policies out of Washington might hurt the economy, so the Fed might come to the rescue. Does that make sense?
Well, I think it makes sense in terms of a framework, but I don't think it's necessarily the way the Fed's thinking about it. I mean, I think that basically the Fed realizes that the trajectory of inflation has been downwards, and even if tariffs had targeted price increases across certain issues, which if there were really full-blown tariffs going on the way it was threatened 2 months ago, there would be. The fact that there isn't tariff-oriented inflation systemically is because there aren't systemic tariffs. He's backed off of most of that. But that's not the same thing as monetary inflation. The sort of extrinsic impact from tariffs is not what the Fed can control. I believe the Fed's primarily driven by the reality of housing, that they have to get the long end of the curve lower because mortgages are what is needed to kind of unfreeze the housing market. I don't think the Fed can talk that way. It's outside of their dual mandate, but I do believe in the subtext, it's more important than they let on.
But how exactly do you do that? I mean, right now you have average mortgage rates, whatever you like, right around that 7% level is where we've held at here. I mean, even if you dropped a full percentage point on the Fed funds rate, as J.D. Vance and the president have asked for on social media, I mean, how much does that even move the needle on mortgage rates, particularly given mortgage rates aren't necessarily solely tethered to where that Fed funds rate is? There are a lot of other factors that go into it.
Well, you're exactly right, but the Fed funds rate is the only one the Fed can control. They cannot control the long end of the curve. They've spent a lot of time over the years learning that the hard way. But there's no question that 100 basis points lower in the Fed funds rate would bring mortgages down. It isn't the only factor, but it's the one they can control. And I think that they would like to see a 30-year mortgage get somewhere with a 5 handle. It probably unthaws some housing and then allows certain activity in the economy that they want to see.
Yeah, I think everyone, including Romaine and looking to buy a house, would definitely love that kind of handle. But they can't control the long end. So, it's just the front end. So how do they do that when there is still so much uncertainty?
Well, remember, the long end is itself somewhat impacted by the short end. There's a term premium, but it's a premium off of what? The short end. So to the extent that the short end is higher, that's still baked into the long end. But to your point, it's not the only factor. But real growth expectations, inflation expectations, they're coming down. Now, the good news for the economy is inflation expectations have come down. The bad news is so have real growth expectations. That's why the 10-year is hung in there right around 4.5%. It really measures, I think, nominal GDP expectations. If you get the long end down to around 4%, and it's mostly because of declining inflation expectations, but real growth hangs in there around 2.5%, then that's probably the Goldilocks scenario for the economy. The Fed cannot control this. They cannot centrally plan it. And I assure you the executive branch of government can't either. But you have a lot of people that want to have their hands on these levers, and that's the problem with the central planning approach. It's very difficult to pull off. So
the screen behind you is dividendcafe.com. So I'm inclined to ask, we know you like the dividend players. What screens well for you right now?
There's a lot of names in healthcare. You mentioned energy before. Certainly with a day like today, you get a geopolitical issue that causes some of the energy names to look good. And we're longer term investors than that. But I think energy, healthcare, consumer staples have some great names that are not at these stratospheric valuations that a lot of the big Mag 7 tech type names might be. So we really like the way that Merck is priced. You got a 4-handle yield at a single digit forward multiple. There's certainly other factors out there that are involved with downward pressure on healthcare, but Merck is a very attractive name. On the consumer staples side, we love Kenvue, Procter & Gamble, Pepsi is right now a great value play. For a patient, disciplined investor that's fundamentally driven, these are really good opportunities, and like I mentioned, energy as well.
No big tech stocks, David? I mean, I know you're looking at dividend plays here, but I mean, do any of those names excite you?
Well, the problem is our tech is so boring. People think it reflects my age because we have made a killing in Broadcom. We made a killing in IBM. But the Mag 7 is all people associate with tech anymore. And within our dividend portfolio, there's just none that are eligible. But certainly the IBM story is one for the ages, and dividend growth led the way through that. Texas Instruments has had an incredible comeback here in the last 2 months. That's a great longer-term play as well. So it's old tech, but it's still dividend growth.
All right, David, always great conversation. David Bahnsen, Chief Investment Officer at the Bahnsen Group.